Hey there, fellow REIT investors. Welcome back to the channel. Over the past 6 months, we've had quite a ride in the REIT market. Anticipation of U.S. interest rate cuts pushed many REITs higher, and optimism was running strong. The iEdge CSOP S-REIT Leaders ETF rallied about 8% at one point. But here's the twist. When the cuts finally came in mid-September, REITs didn't continue rallying. In fact, many fell back. The ETF fell back down by close to 2%. That's a reminder that markets don't move in a straight line, even when the news seems positive. Which is why I like doing these updates, to share what I'm thinking to navigate these shifts in real time. In today's video, I'll run through the 3 REITs I've added to my portfolio recently, and 2 more I'm keeping an eye on for October 2025. My hope is that by sharing my thought process, it helps you sharpen your own decisions, whether you agree with me or not. Before we start, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the REITs discussed, but what works for me might not work for you. Let's dive in. CapitaLand Ascot Trust, a blue chip that's lagging. The first REIT I added is CapitaLand Ascot Trust, or CLAS. Among the blue chip REITs, CLAS has been one of the laggards. While names like CapitaLand Integrated Commercial Trust and Fraser's Centrepoint Trust have moved up strongly, CLAS's unit price hasn't kept pace. CLAS is Singapore's largest hospitality and serviced residence REIT, with more than 100 properties across Asia, Europe, and the US. Its portfolio includes well-known brands like Ascot, Citadines, and Somerset, spanning both long-stay serviced apartments and short-stay hotels. Financially, the latest numbers are steady. In 1H 2025, revenue per available unit rose 3% year-on-year to 150 Singapore dollars, and gross profit increased about 6%. Its core distribution per unit or D.P.U. was 2.40 cents, with total DPU of 2.53 cents, essentially flat from a year ago. On yield, that works out to around 6.5%. Balance sheet-wise, CLAS's gearing stands at 39.6%. With about 1.8 billion Singapore dollars in debt headroom. In May, it issued 260 million Singapore dollars of perpetual securities at a 4.2% coupon. That was sensible when rates were high. But with rates now coming down, refinancing in the future could be cheaper. So while CLAS hasn't outperformed like some peers, its yield remains attractive, and I believe when REITs recover more broadly, it has room to catch up. That gave me a chance to buy in at an attractive yield. Even after the recent rebound, it's still yielding around 6.5%. At one point, it was closer to 7%. For a blue-chip hospitality REIT with a diversified global portfolio, that's not bad at all. My thinking is simple. If the broader REIT market continues to recover, CLAS should have room to play catch-up. And if recovery takes longer, I'm still paid a decent yield to wait. That combination of value and income made it an easy buy for me. NTT Data Center REIT, an overlooked story. Next up is NTT Data Center REIT. This one, I think, is underappreciated by the market. NTT Data Center REIT is backed by Japan's NTT Group, focusing on data center assets across Japan, mission-critical facilities powering cloud, AI, and digital services. At IPO, the REIT projected yields of about 7.0 to 7.5% for FY 25-26. Rising to 7.8% for FY 26-27. Occupancy is expected to climb to 97.6%, up from 94% previously, while revenue growth is projected at 5% per year. Leverage is healthy at around 35%, with an all-in cost of debt of about 3.9 to 4.0%. That's not overly stretched, and with global interest rates easing, there's potential for debt costs to gradually improve when refinancing. Here's where it gets interesting. The unit price for the REIT fell from $1 at IPO to 94 cents, which is where I decided to enter. Since then, it's climbed back to about $1. I'm of course happy with that rebound, but more importantly, I believe the fundamentals are stronger than the initial price action suggests. Data centers are a long-term growth story, demand for digital infrastructure isn't slowing. Yet NTT's REIT hasn't gotten as much attention as peers like Keppel DC REIT. That disconnect was my opportunity. Buying when sentiment is lukewarm, but the long-term demand drivers are intact, is the kind of move I like making. Digital Core REIT, a mix of both stories. The third REIT I bought is Digital Core REIT. My reasoning here is a mix of the CLOS and NTT stories. Digital Core REIT is a pure-play data center REIT sponsored by Digital Realty, with freehold assets across key U.S. and Canadian markets, leased to some of the world's largest tech and cloud companies. In 1H 2025, performance was solid. Gross revenues surged 84% year-on-year, and net property income rose 52% to $46.3 million, supported by acquisitions and stronger occupancy. Occupancy itself improved to 98%, up from 97%. Yet, the DPU was flat at 1.80 US cents, same as last year's first half. On yield, the market is valuing it at about 6.8 to 7%. Its gearing is 38.3%, with average debt cost around 3.6% and a debt maturity profile of 4.2 years. To me, this is a case where the market hasn't rewarded the operational improvements. On the one hand, like CLOS, it's lagged behind the broader REIT recovery. On the other hand, like NTT, it's a data center play that the market hasn't fully appreciated yet. With U.S. interest rates now easing, future refinancing could bring down borrowing costs further. So I see Digital Core as both underappreciated and well-positioned for the next leg of recovery. Before we move on, if you found the video useful so far, do help this uncle out by giving it a like. It really makes a difference for the channel. And if you'd like to go one step further, consider joining as a channel member. And a huge shout out to Peter Lowe, our latest member. Just hit the join button below. What I'm eyeing next. Now let's move on to the REITs I am eyeing, with these REITs firmly on my radar. Sometimes it's just as important to watch patiently as it is to act. Prices, timing, and conviction all need to line up. Eyeing Capital Land Integrated Commercial Trust, the flagship REIT. This is Singapore's largest REIT, with over 24 billion Singapore dollars in assets including iconic malls and offices such as Ion Orchard, Plaza Singapura, Raffles City, and Capita Spring. The latest results were encouraging. In 1H FY 2025, DPU rose 3.5% year-on-year to 5.62 cents, which annualizes to a yield of around 5%. Distributable income grew 12% year-on-year, helped by the Ion Orchard acquisition and lower interest expenses. Portfolio occupancy is healthy at 96.3%, with strong rent reversions, plus 7.7% for retail, plus 4.8% for office. On the balance sheet side, gearing is about 38.3%, with borrowing costs for Capita Spring around 2.7%. The overall debt profile has benefited from easing interest rates, which already lowered interest expenses in 1H. Analysts forecast DPU of about 10.9 cents in FY 2025, growing to 11.3 cents in FY 2026, around 3% year-on-year growth. For me, CICT is the flagship REIT that can lead the sector's recovery. I was discussing with a channel viewer recently about entering CICT. Unfortunately, I missed getting in closer to $2.10. Since then, CICT surged all the way to $2.37 before stalling a little after the U.S. cuts. It is currently around $2.25, which represents a more attractive entry point. Despite the retracing of the upturn, I remain positive. If broader REIT sentiment picks up, CICT is likely to be at the front of the pack. For me, it's not about chasing short-term price moves, but waiting for the right entry to own a flagship name that delivers steady distributions year after year. Eyeing Keppel Pacific Oak US REIT, Tactical Re-Entry. Finally, let's move on to a tactical play. Keppel Pacific Oak US REIT, or CORE, is a U.S.-focused office REIT with 13 freehold properties in tech-driven cities like Seattle, Austin, Denver, and Atlanta. It focuses on business parks and suburban offices rather than downtown towers. 2 months ago, I bought CORE tactically. It rallied strongly on Fed cut expectations, and I sold part of my position at 25 cents. But when the cuts were confirmed, the price fell back to around 22 cents. Unfortunately, I didn't sell all my holdings at higher prices, but well, my timing is never perfect and that's okay. In fact, I'm looking to buy back some of what I sold. Why? Because I still think further U.S. rate cuts in the coming months could support another leg up. This isn't a core holding for me, more of a satellite, tactical play. But at current levels, the risk-reward looks interesting again. The Dividend Uncle's take. Across these 5 names, I'm doing two things at once. 1. Leaning into potential mispricing where fundamentals are sturdier than sentiment, or where dividend yields are still attractive relative to other REITs. And 2. Positioning for the rate path, letting falling average financing costs lift distributions over time. As a value investor and a dividend-focused one, the common thread is that I'm looking for opportunities where yields are still attractive, or where the market hasn't yet priced in the full recovery story. Some are more tactical, like core. Others, like CICT, are about building core exposure. As always, I'm not betting on perfect timing. My aim is to stay diversified, disciplined, and aligned with both short-term opportunities and long-term fundamentals. If I'm wrong on timing, carry yields pay me to wait. But enough about me. What about you? Which REITs are you buying or eyeing right now? At the end of the day, investing isn't about perfect timing, it's about staying consistent, letting dividends compound, and being patient enough to let the recovery play out. Drop your thoughts in the comments, and if this video has been useful, do help this uncle out by giving it a thumbs up and subscribing if you haven't already. Until next time, happy investing!